If you follow the stock market, then you've absolutely heard of Carvana. I mean, it's one of the most incredible, most talked about comeback stories in a long, long time. But how exactly did they pull it off? Let's dig in.
I mean, think about this. A company that was on the brink of complete collapse, now a titan with a market cap that recently blew past $100 billion. The sheer scale of that turnaround is, well, it's just staggering.
And it really has been a rise from the ashes. You have to remember, this is a company whose stock dropped 99%, 99, back in 2022. So many people had written them off for good. And yet, here they are, dominating.
But what if that amazing comeback story isn't quite what it seems? What if the whole thing is built on a foundation that has been very carefully and very deliberately hidden from all of us?
Well, that is the exact question being asked by a firm called Gotham City Research. They just published this incredibly detailed report that basically throws this entire feel-good comeback story into serious doubt.
Okay, so it is really important to understand what a short seller is before we go any further. Gotham City Research is an investment firm, and they make money if Carvana's stock price goes down. So they have a direct financial incentive to see the company's value fall. We're going to walk through their findings from the report, but you've got to keep that perspective in mind.
And their core allegation? It's a total bombshell. They're claiming that Carvana's recent earnings, the ones everyone's been celebrating, are overstated by more than $1 billion. And that its success is way more dependent on secret help from related companies than anyone realizes.
So how do they claim to know all this? Well, Gotham says they found the smoking gun, the annual financial report for a very closely related but private company. And get this, they got these documents through a Freedom of Information Act request after they allege Carvana actually tried to keep them sealed in court.
And this brings us right to the heart of their entire investigation, this really interesting relationship between two companies that are tied together by one family.
So on one side, you've got Carvana, the big public company run by CEO Ernest Garcia III. And on the other side, you've got DriveTime, a private company owned by his dad, Ernest Garcia II. Carvana was actually born out of DriveTime, and because DriveTime is a private company, its finances have been a complete black box for years. Well, until now.
Now, this is where things get really fascinating, according to this report. Just look at the numbers. As Carvana's free cash flow suddenly, almost miraculously, turns positive in 2023 for the first time ever, look what happens to DriveTime's cash flow. It completely craters, going from positive to massively negative. It's like their fortunes are at perfect mirror image of each other.
And this slide really puts the scale of that problem into perspective. The report alleges that between just 2023 and 2024, DriveTime burned through over $1 billion in cash just from its core operations. $1 billion. Poof. Gone.
This massive cash burn, Gotham claims, is being fueled by something that might be even more alarming: a quiet explosion in hidden debt.
Now, the report makes a point of showing that for years and years, DriveTime was actually a pretty careful company. It managed its debt levels really prudently, kept things stable, under control.
And right here, this is where the story takes a wild turn. This table from the report shows DriveTime's leverage ratio, basically its debt compared to its earnings. And you can see for over a decade it was super stable, right around 10x or less. Then, boom. In 2023, the exact same year Carvana's profits suddenly appeared, it just skyrockets.
40.2 times. Let that sink in. According to the report, DriveTime's debt suddenly became more than 40 times its earnings. This is what Gotham City Research calls the debt bomb, ticking away quietly, just out of the public's view.
And here is the comparison that Gotham argues is the key to this whole thing. While Carvana was out there publicly telling Wall Street it was getting healthier, reducing its leverage to a nice, respectable 2.8 times, its sister company, DriveTime, was privately taking on a mind-boggling 40 times leverage. The report basically argues the debt didn't just disappear, it was just moved next door.
Okay, so this all leads to a really obvious question, right? If DriveTime is burning through $1 billion in cash and taking on all this debt, where is all the money coming from just to keep the lights on?
Now, the common theory, what a lot of skeptics just assumed, was that the owner, the billionaire Ernie Garcia II, was just using his massive personal fortune to prop the company up, covering the losses himself.
But the financial documents that Gotham got their hands on seem to tell a very different story.
The report claims the money isn't coming from the owner's pocket at all. Instead, DriveTime went out and raised over $1.4 billion in brand new debt during this time.
And here is the real kicker. The report alleges that not only is the owner not putting money in to cover the losses, he was actually taking money out. These documents allegedly show a net extraction of $352 million by the owner, cash that was funded by all that new debt.
So, when you put all of these pieces from the report together, what's the picture it's trying to paint? Well, Gotham argues it reveals a financial house of cards.
They call it this reverse pyramid theory. So at the very top, you have Carvana's publicly celebrated profits. But those profits, they claim, are being artificially held up by this massive 20 to 40 times leverage at the private company DriveTime. And that leverage is backed by what the report calls toxic subprime auto loans. And the very foundation of this entire structure, they allege, is just a series of accounting and loan irregularities.
And that leaves us with the central question of this whole affair. Is Carvana's incredible comeback a genuine miracle of modern business? Or is it, like this short seller's report suggests, just a carefully constructed mirage built on top of a mountain of undisclosed debt that's been hidden just out of sight? That is the billion-dollar question.